Hello, this is BBC News with the latest headlines for viewers in the UK and around the world. I'm Samantha Simmonds. Are soaring prices finally easing? Wall Street shares hit a new record after the biggest drop in US inflation in more than a year. Simply not enough. The White House urges OPEC to get pumping to take the pressure off oil prices. Less clicking, more collecting. eBay disappoints as more of us return to the shops. Plus, we're not just throwaway fashion. The boss of Boohoo takes on the environmental critics with a pledge to be more sustainable. Hello, well, we start in the US, where Wall Street shares have closed at new record highs on hopes that soaring inflation has finally peaked. America's Consumer Price Index rose 0.5% in July. That's almost half the rate it rose in June. That's the biggest drop in monthly inflation in 15 months. Well, why is that so important? Well, it means the Federal Reserve may not be under such pressure to start removing stimulus measures. In other words, cheap money could be around for a good while longer.
That is not our goal.
Rapid increase in prices, I do think has peaked. And now with the Delta variant slowing the economy to some degree, I think that acts as almost like a rate hike in some ways.
Here are your latest headlines.
But when you go out here in the West Coast, it is busy. It is packed last weekend. So the economy is still just, bursting at the seams. So very, very positive on economic growth. But I do think things like used vehicle prices and energy prices that had really driven inflation have probably peaked, especially energy prices. So we never thought inflation was going to be a long-term problem, and we still don't think it's a long-term problem. I think the bigger long-term risk is slower growth, not inflation.
Well, despite that big easing of inflation, the White House is worried about the high cost of fuel and whether it risks choking off the economic recovery. Brent crude is up around 35% this year, and President Biden and his advisors are calling on oil producers to raise production. But it's put them in an environmental dilemma, as Michelle Fleury reports.
The White House is responding to a jump in oil prices by calling on OPEC and its oil-producing allies to boost production. Now, in a statement, White House National Security Advisor Jake Sullivan warned higher gasoline costs, if left unchecked, risk harming the ongoing global recovery. OPEC and its allies did recently agree to increase production by 400 barrels a day. But Mr. Sullivan said, at a critical moment in the global recovery, this is simply not enough. The move comes as the Biden administration has tried to push back on inflation concerns. Inflation remained high in July, but showed some signs of easing as the recovery from the pandemic continues and supply problems remain. Mr. Biden has also been criticised over his energy policy by Republicans, who say he has put environmental interests above those of oil and gas companies.
Michelle Fleury there. Well, let's get more on this and talk to Janet Moyi, who's Investment Director at Brewin Dolphin here in London. Welcome to you. Good to see you as ever. So let's start with those record highs on Wall Street. What's your analysis?
Hi, good morning, Samantha. Thanks for having me. Yes, I think financial markets are very relieved at the inflation report because it shows that inflation is indeed showing signs of being temporary in nature, which is what the Federal Reserve have been saying. So markets are very pleased with that because just last week we had a very strong labor market data with the US economy creating about 2 million jobs in the past 2 months. So that really have worried the market that the Federal Reserve will have to tighten monetary policy earlier than expected. So that slower inflation growth is very welcome news for markets.
And what do you think it will mean? Do you think it will mean that cheaper money will be around for longer? There'll be a delay to expected interest rate rises?
Yes. So we believe that the very massive bond purchase program will have to be scaled back at some point. And I think markets get that. I think the main concern is that they have to do it in a more aggressive, faster pace than they needed to. So I think this slower than expected inflation report suggests that the Fed can be patient so they can scale back the policy but they can do it in a gradual manner. And I don't think it would change the fact that they are planning to raise interest rates sometime in 2023. That's still quite far off, and we still continue to expect an ongoing recovery in the economy towards the end of 2023. So we don't think the interest rate hike timeline has changed, but it's just that when they scale back their massive bond purchase program, they can do so in a more gradual way.
And how much of an issue is this dilemma over opening the taps on oil production and the Biden administration's commitments on the environment?
Yes, I think that's a short-term and long-term issue here. So in the short term, we are seeing very strong oil demand, primarily because of the reopening of the economy. People are traveling again. And at the same time, OPEC Plus have previously cut production during the pandemic. And despite raising that production during the latest deal, it is simply not enough in the short term to meet that rising demand. So in the short term, they do need to raise production. So I think the environmental issue, the climate change fight, is more of a more secular theme. Of course, we have to reach that goal, but I think the Biden administration wants to solve that short-term high oil prices, which can weigh on the economy.
OK, Janet, great to see you. Thanks very much for your thoughts. Well, let's stay in the US because eBay is predicting weaker than expected revenues for the current quarter, adding to evidence that the pandemic online shopping boom is waning. Last week, Amazon's results and forecasts disappointed Wall Street as more people around the world returned to physical stores to do their shopping. eBay's earnings rose 14% in the 3 months to June, but that was the slowest growth in a year. Well, let's talk to Joseph Evans, who's head of tech at Enders Analysis. Joseph, welcome to you. Thanks very much for being with us. So what do you make of these new results? Still growing, but slower?
Yeah, well, it's a mixed bag as a quarter for eBay, I think. Obviously, as you say, growth dropped from the really heady levels it had been for the past year. But, that is because it has this really tough comparison with Q2 last year, which was the first kind of full quarter of lockdowns and mobility restrictions, which really forced people suddenly to shop online in enormous volumes. I mean, imagine April last year, you're working from home with no warning. You need to buy a desk, you need to buy a computer screen, you need to buy gloves and hand sanitizer. And you had to turn to online shopping. So we saw this enormous boom last year, and now we're sort of comparing with that boom. And they did grow ahead of expectations once you take into account divesting their business in Korea. So as I say, slower growth, but still impressive, I think.
So it has benefited from the pandemic, but do you think that it can retain its customers?
Well, that is the big question, and that's a question for all these online companies that are doing so well at the moment. What happens to this increased online activity as life returns to something resembling normality? And I don't think anyone really knows the answer to that. It depends on things like how much does working from home continue. But I think certainly there's a large group of people who tried online shopping for the first time, found it was kind of more convenient, safer and cheaper than maybe they were expecting. And I think a lot of that activity is going to stick around.
So eBay has been written off many times in the past, and as you say, it's unclear whether or not people returning to the office will have an impact on its business. But where does its business model go from here? How does it continue to push forward?
Well, it's trying to focus the business. It's been selling ancillary elements like the courier business, like its classifieds business. So it's been focusing there. It's also trying to move to kind of higher value items rather than the kind of cheap fast fashion that you might sell for a small amount, where there isn't a lot of profit to be had for the platform. They've been trying to move to expensive watches, designer sneakers, really high value items that they can extract a bit more money from. And on top of that, they're looking to kind of control the whole user experience, control the payment system, so that customers and sellers have more confidence and are happy to transact more, just streamline the whole experience and focus it.
And how has it managed to capitalize on trends at all?
Well, one of the big things that's been going on during the kind of this year has been the arrival of these enormous kind of collectibles markets and their enormous growth. Things like trading cards, things like sneakers or watches, vintage video games, anything that you can kind of trade and collect has had a huge boost. I think a big part of that is, there is a very fortunate segment of the population that from a financial standpoint is actually better off now than they were at the beginning of the pandemic, because they haven't been able to go on holiday, so they've been saving money. They haven't lost their jobs because they've been able to work from home, and they are sinking really quite astonishing amounts of money into these hobbies like collecting $10,000 watches. And eBay is the perfect place to trade that stuff, because it's it's user to user. You're not going to a shop. You're buying from someone across the country who has exactly the trading card that you want in exactly the condition that you want. So it's talking a lot about that. Now, I think it's an open question the extent to which markets like that can continue to be so bullish for so long. So that's something that could maybe fade going forward. But so far, eBay's been a big beneficiary of that trend.
OK, Joseph Evans there of Enders Analysis, thanks very much for being with us. There is rising tension between the Kremlin and global tech giants. Under Russia's new digital residency law passed in July, it's compulsory for foreign tech firms to pay taxes in Russia and have a local office or risk being hit by fines. But there is a political dimension too, as BBC's Monitoring's Ksenia Idrisova reports.
Russia is one of only 2 countries in the world where Google doesn't reign supreme. There is an ongoing tug-of-war between the world power and foreign tech giants, and the consequences are likely to intensify. The Russian government has been hitting them with fines. And one reason is because under a law brought in last month, foreign tech companies with more than 500,000 Russian users must legally have an office in the country.
Russian Secret Service, Russian law enforcement bodies would be able to have full access. We recognize it as a serious infringement to privacy.
This law also says that if internet services don't comply, as a last resort, they can be blocked. The Kremlin has cut off their internet before, temporarily or in particular regions, to counter anti-government protests, for example.
When Russian authorities are taking certain restrictive actions, they say that it's not us. We're just answering some aggressive behavior of our international or Western partners, labeling certain content as disinformation online.
YouTube, owned by Google, restricted several videos from one of the most watched news channels on the platform, RT. After that, the Russian authorities announced that YouTube had more illegal content than any other social media outlet. And in Russia, companies that don't take down illegal content fast enough can be fined. In January, leading Kremlin critic Alexei Navalny was jailed. Huge unsanctioned demonstrations broke out in his support. The tech giants did take down some videos announcing protests, but the Russian government still warned Google's local division they'd be fined up to 10% of their revenue for a repeat offense of not deleting content that promoted extremism, violence, or drugs. Technically, that could mean over $100 million in fines if they don't fall in line.
To Asia now, where Chinese electric car maker Li Auto has made its debut on the Hong Kong Stock Exchange. So how's it doing? Katie Silver is looking at this in Singapore for us. Hi, Katie.
Hi, Samantha. So, not that well. Been something of a muted opening. It opened down slightly, and now more or less it's trading as it opened, about $118 Hong Kong a share, or just over $15 US. But to be fair to it, this is what it trades for in the US, where it's also trading. So the company has been around since 2015, and with this expansion, it hopes to move into improving its research and development and expanding its infrastructure. But it listed last year on the Nasdaq, and during that time, we've seen it do very well, up about 80%. Now, the interesting thing about this company is it's the latest so-called homecoming company. So these are Asian companies, generally Chinese companies, that often listed to great fanfare in the US. And then after a few years, or just really in the last 18 months, many have chosen to dual list or list here again in Asia. And exchanges such as Hong Kong, Shanghai and Shenzhen. Now, part of this really is because they're seeing a lot of regulatory pressure, and some analysts, for instance, say it's about trying to hedge against this risk of potentially even being delisted. We've seen a number of big Chinese companies, for instance, being delisted from the New York Stock Exchange just recently. And there's also been promises from Washington, for instance, to make these companies face more regulatory hurdles, part of this big tensions that we're always talking about between the US and China. The other aspect too is it's part of seeming to broaden their investor base. You know, if you're operating in Hong Kong or some of the Chinese mainland stock exchanges, you can actually get yourself access to many more Chinese mainland investors. And of course, they've got a lot of money to spend. But there is a couple of risks for this company. I mean, we've seen Chinese stocks in recent weeks really take a hit in Hong Kong. It's been a volatile time with Beijing saying, for instance, it's going to be cracking down on tech companies and the like. But this company may well find itself in the clear, in part because it specialises in environmental technology, which Beijing is so keen on.
Casey, for now, thank you. Let's get some of the day's other news now. Oil giant Shell will pay more than $100 million to communities in southern Nigeria whose land was polluted by oil spills in 1970 during the Biafran War. Shares in WW International, formerly known as Weight Watchers, have died 25% after the firm said people were putting diet on hold after lockdown. Google employees in the US who opt to work from home permanently may get a pay cut. The technology giant has developed a pay calculator that lets employees see the effects of working remotely or moving offices. Stay with us on BBC News. Still to come, a tough journey for the travel trade, but is the world's top travel firm on the road to recovery?
The big crowds became bigger as the time of the funeral approached. As the lines of fans became longer, the police prepared for a huge job of crowd control.
Idi Amin, Uganda's brutal former dictator, has died at the age of 80. He's been buried in Saudi Arabia, where he lived in exile since being overthrown in 1979.
Two billion people around the world have seen the last total eclipse of the sun to take place in this millennium. It began its journey off the coast of Canada, ending 3 hours later when the sun set over the Bay of Bengal.
This is BBC News, the latest headlines. The Taliban fight for Afghanistan's second city, Kandahar, as the BBC speaks to the militants' leaders exclusively. Poland's parliament votes to tighten control of the media. The US says it's deeply troubled, warning it's a threat to freedoms. Now, the fast fashion business model has come under increasing criticism for its environmental impact. Its critics say the industry pushes cheap, throwaway clothes, often made of highly polluting man-made fibres. Now, the boss of online fashion giant Boohoo has been responding to these claims and to allegations of poor pay and conditions at a supplier's factory in England. He's been speaking exclusively to the BBC's Sean Farrington.
Boohoo Chief Executive John Little is rolling out hundreds of millions of pounds of investment across factories, offices and distribution centres like this one in Burnley.
This is where your order gets put together. So as the picker is picking, they're picking in an order, but actually it's different customer, different brands.
Creating thousands of jobs, but almost more crucially for its business, installing more automation. His customers shopping online demand it.
Consumer habits have changed to wanting to buy online, but equally the immediacy of when they want that order. So, you know, if you think of it today, you know, a package can be ordered at 10:55 p.m, it can be picked, it can be packed, it can go to a courier, and it can be in your home by tomorrow. So that's probably one of the biggest trends that we've seen in the last sort of 18 months, and that's only getting greater and greater is what I would say. So, you know, kind of, will same-day delivery become important? Absolutely. But not quite yet. At the moment, it's all about next day.
Is that a target for you?
I think without a doubt it's going to happen.
Boohoo isn't a business that can only look forward, as it still deals with the fallout from revelations about poor conditions and illegal pay for workers making clothes for the retailer in Leicester. One investigation found Mr. Little was personally very aware of what was going on.
Shouldn't you have resigned?
Well, I think my role is to make sure if there's a problem to fix it. If I'd resigned at the time, that would have set us back in terms of the time it would have taken to do what we needed to do. So for me, I don't recognise that as the answer. I think the answer is always to, if you've got a problem, fix it.
It's not just the treatment of workers that make these packages that's an issue for the industry, but in a week where we've had a code red warning for humanity, the fashion world has big questions to answer about making these products sustainable. Can the industry work for the planet and for the workers in it?
Yes is my answer to that. You know, if I look at across all of our brands and I look at the number of items and the average number of times per year that somebody buys, we don't see that as a throwaway. You know, sometimes fast fashion is seen as I buy it, I wear it once and then I throw it away. That's certainly from the data that we have, we wouldn't correlate with that. But you know,
but looking at all of this that we have here, I mean, this is here because people want to keep buying, even if they're keeping it. They're buying. That is not good for a planet that we need to get on top of, is it?
And I think, you know, but the reality is, you know, we all have to wear clothes.
Now, in the next hour or so, we'll get an idea of how ongoing travel restrictions are affecting the world's biggest travel company. TUI owns 1,600 travel agents, 5 airlines, 400 hotels and 17 cruise liners. It's about to report results for the 3 months to June, normally the start of its peak holiday season. But the pandemic has seen it cut thousands of jobs and seek a multi-billion-dollar bailout from the German government. Well, let's get more on this and talk to Martin Alcock, Director of the Travel Trade Consultancy. Martin, welcome to you. Thanks very much for being with us. So,
morning.
What do you think we can expect from the results?
Yeah, well, look, morning. As you say, this announcement covers the trading results for the period up to the end of June. And because the way TUI recognises its profits and its revenue, it only recognises that when people actually depart on a holiday. And so for that reason, it's going to be a pretty poor set of results again. Better than the 2020 equivalent, because we were in full lockdown back then and there wasn't anything really happening, but still way down on pre-pandemic levels. If you look at what some of the airlines have reported recently, EasyJet and Ryanair, for example, in that same quarter reported only around 10 to 20% of passenger volumes relative to June 2019, you know, the equivalent pre-pandemic quarter. So I think TUI could be looking at a similar ballpark in terms of their actual results. What's much more interesting, though, is I think the data they report on the very latest booking trends and what the forward piece looks like. That'll give us that real sense of how consumers across Europe actually have reacted to restrictions being relaxed over the last few months.
And what do you think we will see from that, given that restrictions in many countries only relaxed really in the past few weeks?
Yeah, well, look, what we're seeing across our travel company clients is what you'd call a two-speed recovery, really. Across Europe, we're seeing huge numbers of bookings coming in already. Some of those airlines we just mentioned are talking about their European bookings for future travel being almost back to 2019 levels, ever since the EU launched its digital passport scheme back at the start of July. I think it's a similar story in the US as well, actually. You're starting to see US consumers, less relevant for TUI, but you're starting to see US consumers traveling. The UK recovery, sadly, is just way behind that. It's much slower. Frankly, that's a result of the pretty chaotic approach the government's taken to opening up international travel. This sort of flawed traffic light system, I think, is really having a detrimental effect on consumer confidence to book, just given the continual changes. Mexico is a very recent example of that, where it moved to the red list. So I expect TUI's results to mirror that. Bookings in, say, it's German business, which is a very big component of that, I expect to be roaring and like I say, almost back to pre-pandemic levels. UK probably still a bit sleepy and behind the curve.
Just briefly, Martin, what is it now that you think the travel industry wants to see from governments to help it going forward?
Well, it's going to be a really long road to recovery. All of these businesses have taken on huge amounts of debt to fund themselves through the crisis, and that's going to have to be repaid or restructured in some ways. So I think the best we can hope for, you know, getting people traveling again is the short-term priority for these companies, because confidence is so fragile, as I mentioned. I think the best we can hope for is some stability from the government in this traffic light system. They have said that they won't be changing the ratings for another couple of weeks. So there is just about a bit of time for people to grab that sort of last-minute holiday for this summer, although realistically, this summer is gone and it is more about the next season. So I think a bit of stability is about the best we can hope for. Martin Alcock, great to talk to you. Thanks very much for joining us. My pleasure. We'll, of course, bring you those 2E results when they come into us. That's it for me. You can reach me on Twitter. I'm at Samantha TV News. Have a great rest of your day.